Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Datia. We have with us Tamal Badapatiya, veteran business banking journalist, joining in. Welcome to the show, Tamal, and always a pleasure to get insights from you and understand actually what's happening on ground. Tamal, over the way the pandemic has panned out in the last 18 to 24 months, the RBI overall has been really proactive in the kind of measures that they have taken as well. What's the sense that you pick up and how are you seeing the transition now?
Thanks, Hiral. Merry Christmas, Happy New Year. It's again, and the caveat is we do not know. It's still unknown the so-called third wave, how severe or how light it will be. Now, if we presume that the Omicron would not hit us as much as the second wave did, then we would like to believe the worst is behind us. If you look at the key indicators in terms of bank credit, it started picking up. Past 2 months, every banker you talk about, they're talking about credit pickup, corporate credit. So those who have been, sitting on the fence now taking the investment call. State Bank of India, country's largest bank, which have roughly about 20% market share. The MD and the chairman, Mr. Khara, had said repeatedly over the past week or 15 days that he is seeing credit pickup, and others are also. So till now, the credit was driven primarily by the retail, but now the corporate credit also started picking up. That's point number one. Point number two, if you see the bad loan creation, that's also not as much as RBI had anticipated. RBI's 6-monthly review, the so-called FSR in June and December last year, whatever the projection were there, actual bad loan accretion is far lower than that. So on the both counts, new loan is being created, new credit pickup has started. Bad loan creation is not as much as we had apprehended. In fact, the September quarter result was the best in recent past, both for the public sector as well as the private sector banks. The primary reason is not a higher interest income, but lower provisioning, because the fresh accretion, the fresh slippages was much lower than the banking sector apprehended or the regulator thought it would be. So if the trend continues, of course, there's a catch. There are at least certain quarters that believe that bankers are not telling the truth. Situation is not as rosy as they are. They are hiding. So I don't know exactly, but the Reserve Bank of India's latest norms, which is applicable to both the banks and NPAs on the recognition, asset recognition, the income recognition, and the classification norms, etc., are pretty clear. So you can't hide it in any which way. So I would like to believe that if the third wave does not hit us, the worst is behind us, both in terms of asset quality as well as new asset creation.
Right. And right now, if you see in terms of credit growth as well, we're seeing a number of around 6 to 7%. What's the average, according to you, that we should be reaching to see a good banking system from here on?
If you look at this, we have been seeing a very low credit growth. Even before COVID, we had seen credit growth was pretty low, and for multiple reasons. Now, ideal situation, people say that is 3 times the GDP. That should be the credit growth. In fact, if you look at the highest credit growth historically in Indian context, happened between 2006 and 8, 6, 7, 8, when Dr. Reddy was the RBI governor. I'm talking about fiscal year 2006, 7, 8. At that time, the credit offtake was probably 3 times the GDP, even more than that. I think one particular year it happened. Now, I think we will never see that kind of growth anymore. There are multiple reasons behind it, but one of the key reasons also, and we must take cognizance of that what credit growth we see now and what credit growth we had seen in 2006-7, that the highest credit growth time, is very different, because now the growing disintermediation in the financial sector. So the so-called bank credit does not catch the entire credit growth. As the non-banking finance companies, the NBFCs are there, and there are multiple other platforms, like P2P lending and so many other tech-driven platforms. They are also giving credit, not corporate credit, but retail credit. So banks' credit growth does not signify the entire credit growth. We must take into account that. Having said that, what you're talking about, 6 or 7%, I think it will definitely grow. And there also will be a change. There are two changes. One is the composition of credit. Till now, particularly the past 2 years, credit growth was primarily driven by retail customers. But I think we will see, definitely, we have started seeing in September quarter, we'll see it in December, and going forward, that there will be corporate credit growth also. That's one part of it. And second part of it is this: when the credit growth was happening, till now, what was happening? You will find that industry credit growth is X, but you will find many banks, they are not growing at all. So what was happening is this: some of the other banks, they were snatching the customers from other banks. So that was happening. The industry, it is not that every bank was growing their credit portfolio. But I think now we'll see a situation. Credit growth was not driven by one bank snatching others bank customers. It will be like probably every bank will, if not have an equal share, but those who are in the negative growth or no growth at all, I think they will also see some.
Right. And overall, with the recent RBI policy as well, Tamal, they've maintained their status quo on rate suspension. What's the sense? By when do you see a change in stance happening? By when do you see RBI going ahead and increasing rates?
Well, yeah, I think what RBI has done is a pretty smart thing. There's no change. There is no change in stance, and there is no change in the policy rate. But what they have done is, I would call it raising rates by stealth. What happened is this: what is the two rates now in India? One is 4% repo rate, the rate at which banks borrow from RBI, and the other is the reverse repo rate, which is 3.3%, the rate at which banks park their excess money with the RBI. Now, it's a liquidity flush situation. In a liquidity flush situation, repo rate is unimportant, insignificant, doesn't make any sense. I mean, the real policy rate is the reverse repo rate, so 3.35. Now, is this the real reverse repo rate now? Yes, it is. But is it the policy rate? No, because reverse repo rate, the money going through the reverse repo is very little. Bulk of the money is going through the so-called variable reverse repo rate auction, which is as much as 4.99 in some cases. The weighted average could be 4.97 or 98. So which means 4.35 reverse repo rate is not important at all, because Reserve Bank of India is absorbing excess liquidity through the variable reverse repo action, which is close to the repo rate. So this is the way RBI has tightened, even though it has kept its rates unchanged, but for all practical purposes, market rates have gone up. Now, what do you see going forward? If you have noticed, the RBI language has changed. Earlier, it was talking about to secure growth before taking any rate action or monetary tightening. But last time, December policy, RBI governor spoke about not only the growth should be secured, but it has to be broad-based. So I don't see any change in the accommodative monetary policy in the next few months. I would like to believe the policy rate will remain, the stance will remain accommodative. And but probably post February we'll see, because the next policy is February, and by the time the budget will be in place, we'll get a clear idea about the government borrowing program. Anyway, government borrowing program will be costlier for the next fiscal year, because the market rates have gone up. If you look at the 10-year bond, 10-year treasury bill yield also, it has gone up, etc. So the key question is this: will Reserve Bank of India change its reverse repo rate in February? I'm not very sure. I will not be surprised if it does not do so. If it continues to decide the rate through the VRR, the variable reverse repo auction, But going forward, yes, there will be a reverse repo rate hike, which is bridging the gap between reverse repo and repo, which is 65% now, 65.65% or 65 basis point, 4% and 3.35. So first we need the reverse repo rate need to go up to bridge the gap, probably bring it down to 25%, 25 basis point, and then the repo rate hike will come. So my guess is during the calendar year beginning next week, beginning 1st January, I meant later this week, probably we will see 2 rate hikes. I mean the repo rate hike. But nothing is going to happen very soon. Rate has already been tightened. RBI has done so without saying.
Right. So with that, how important, Tamal, does inflation become now? Because across the globe, you are seeing inflation, which is one of the major concerns that the central banks have been looking at.
Yeah, of course. I think the perception is, our perception is the inflation will be around anything between 5.25 and 5.5 for the next year, which is higher than Reserve Bank of India's target 4%. But if you have noticed, Hiral, that we don't talk about 4% target anymore. The goalpost has shifted.
Yes.
We always talk about 4% plus and minus 2 percentage point, which is 6% on the higher side. So that's what happened in the past couple of, ever since the COVID has struck us. We are not talking about inflation target 4%. We are talking, not we, Reserve Bank of India presume that 6% is the target. As long as below 6% is good. That's the kind of impression the central bank is not saying so, but we are seeing this test happening. But having said that, RBI has been reasonably successful in containing inflation. It was not skyrocketed. The way it's very different, the character of inflation, what happened in the US. US's target and inflation, actually the gap is far wider. So in our case, even if it's 5.5%, it is within the wider base of 4% plus and minus 2%. So inflation is a threat, but what the popular perception even till now, it's basically the supply side disruptions and not as much as demand-led inflation. So we need to keep our finger crossed, but I would like to believe that inflation will be an issue going forward, and which is why RBI will not. Because the demand pickup we are seeing, credit pickup also will actually strengthen the belief that there is been demand pickup. So RBI cannot let its guard down. RBI will definitely take cognition of inflation, which is why I spoke about probably 2 rate hikes during the year. But at this point of time, which is the Bank of India repeatedly emphasizes this, in RBI scheme of things, growth is more important than containing inflation. So which is why I would like to believe that RBI is not in a hurry to officially hike its rate.
Right. So Tamal, with all of this said and done, how are you viewing fiscal deficit from a macro perspective, taking into consideration how the balance of payment is panning out, how the current account deficit is, and thirdly, overall in terms of the business environment and the government and the private expenditure goals?
No, I think if you look at the current year, things have been, I would say, according to the plan, and probably we have done better than what it was envisaged. If you look at whether it's GST collections and all the micro data in terms of in terms of revenue mop up, not bad at all. It's pretty good, better than what it was envisaged. And the perception is government should not be. Let it be. Let's focus on growth. Let's not be too. I'm just saying, let's not be too rigid on the fiscal deficit front. That's what the economists have been saying. The economic trackers have been saying. So I would like to believe. Of course, there are concerns, but these concerns, if government goes for, so there is a sudden way of bring down the fiscal deficit then the cost we need to pay, probably that's not the right way to do it. I would like to believe that the government borrowing program, which was 12.5 trillion last year, will remain at the similar stage. It will not go up, but it will not go down also. And then you have, of course, on the other side, the LIC IPO and the bank privatization, etc. The kind of money which government, I mean, it's not going to happen probably this fiscal year, but definitely it's going to happen for 2023. So yes, I will not be unduly worried.
Right. And very lastly, Tamal, overall, if someone has to look at the next 6 to 12 months, what are the key factors that one should focus on to understand the functioning and the status of the banking system and the economy as a whole?
No, the budget is coming, which is just about a month away, probably. So we'll get to see. So the key things to watch out for: the number of the fiscal deficit number, and the government borrowing program. As I said, I don't see there's any surprise on the fiscal deficit front, and also the government borrowing program should be around 12.5 trillion, which had been the case in the current existing year, because the redemptions I understand is higher than this current year. So these are the two key things we need to watch out for. We also need to watch out for the inflation number. We need to watch out for the credit growth and the fresh slippages. As far as banks' balance sheets are concerned, and the key important part we need to see is this provision coverage ratio. So some of the banks have done pretty good, late 90s or close to 100% provision coverage ratio, but there are quite a few who are not as much, probably in the 70s and 60s. So if there's no fresh slippage, and if they are in the operational operating profit is higher, probably they should focus on solidify their balance sheet by boosting their provision coverage ratio. So that's it. But the key question, as I said, is something which is you and me, we do not have any control, is the third wave. So more vaccination, even the younger people, that we have taken a call decision, that's going to happen. I'm not very sure about what is going to for the booster dose. I think that also we need to see that. So it all depends on if. Finally, I would like to believe that if there is no third wave, and if we prepare ourselves well by covering the population with the vaccination and ensuring start of the booster dose as early as possible, we can probably avoid any kind of severity. Even if the third wave happens, we can avoid that. And if we don't have third wave, definitely the worst is behind the banking sector, and worst is behind the economy. And of course, as I said, the two bank privatization and LIC IPO, which may not happen this current fiscal year, probably will happen this year. So that will also give a booster to the government's revenue. So all in all, I will not be extremely worried about that. I would like to believe that the worst is behind us. So better things. I would like to believe, better things.
Absolutely.
To look forward to.
Absolutely. And that's something we should be watching out for as well. Thank you, Tamal, so much for joining us on the show. As always, a pleasure to speak to you. Thank you so much. Stay safe and speak to you soon again.
Thank you. Thanks. Stay safe, Suraj. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.